Hello everyone, welcome to EduTap. So in today's session we are going to discuss a very important topic, that is today we are going to discuss about the numericals, that how you can convert from one concept of the national income to the other concept of national income. Okay, there are in total 8 concepts of national income. So today we will see that how can you convert from the GDP MP to the NNP FC, and we will see that why this topic is very important of the conversion. Okay, that is, it has been asked in the previous year questions of the RBI Grade B, and even for SEBI Grade A it is very important. So before starting with the session, please subscribe to our YouTube channel if you are new to the channel, and join our Telegram channel for the PDF of this session, and you can get the link of the Telegram channel in the description box below. So here is the reason that why these concepts or why the conversion is very important, okay, from the exam point of view, because a previous year question has been asked in the RBI Grade B of 2018 that NDP-FC plus the net factor income from abroad. What does this represent? You have to tell, and this you will surely be able to tell after you understand that how are we converting from one concept of the national income to the other concept of national income, that from GDP MP we are converting to GNP FC or we are converting to NNP FC, that how such kind of conversions can happen between the concepts of the national income. So next question that has been asked in the previous year of the RBI Grade B, that was asked in 2019, okay, and the question was that the term national income represents, okay, many of you must know that the national income is the NNPFC. So you have to tell that among which of these the NNPFC is there. Directly it has not been given that the NNPFC is there, okay, you have to actually calculate and convert one concept to the other. So that's why it becomes very important for you to understand the conversion process. Okay, now we will see that if there is GDP MP, okay, and NNP FC. First we will see that how from MP to FC or from FC to MP you can convert. So what is the meaning of MP? MP means the market price. That is, what is the price that is going on in the market that the consumers have to pay. So let's say a pen costs 200 rupees. Okay, a pen costs 200 rupees, while the factor cost is the cost of the production, we can say, or more factor cost of the production, that how much the factors are being paid, how much the earnings of the factors of production is there. Factors of production is there if they are providing their services for the production. Okay, so we have to see that what are the earnings of the factors of production, or for as they are providing their services for the production. So factors of production are land, labor, capital, entrepreneur. So land is earning the rent, labor is earning the wages, the capital is earning the interest, and the entrepreneur is earning the profits. So these are the factors of production, and they are providing the factor services in the production process, and they are earning something from producing. Okay, they are earning the rent or wages, or they are earning the profits and interest. So if we can say that they are earning only 170 rupees, so this 30 rupees extra, where is it going? If they are earning from the production of a pen, they are earning 170 rupees, while the cost of the production, while the market price of the production is 200 rupees. So this 30 rupees, where is it going? So this we can say it is the indirect tax that the government is taking. Okay, as well as there might be some subsidies that is given by the government for the production. So let's say the subsidies are 10. So these are going to the factors of production. The 10 rupees extra, 10 rupees that is given by the government is going to the factors of production. So we can say the 10 rupees is being added here. So it is 180. So market price is the price that is going on in the market that the consumers have to pay. The factor cost, we can say it is the cost of the factors of production for hiring the factors of production, or it is the earnings of factors of production because they are providing their services, okay, in the production process. So I hope you have understood the logic behind the meaning of the MP and the FC, and if you have understood the logic, you will easily be able to understand that how we are converting from the GDP MP to the NNP FC. Okay, let's see here, only FC to MP we have to convert. From the FC we have to go to the MP. So what will we do? That we will add the indirect taxes, because in the market the consumers have to give the indirect tax, and we are deducting the subsidies that is given for the production subsidies, we can say, because this production subsidies the consumers have not to pay. This is paid by the government. So we are deducting the production subsidies. If we have to come to the NNP FC from the GDP MP, what we will do? Okay, if we have to convert from the MP to FC, we will deduct the indirect taxes, because this indirect taxes is not the earnings of the factor cost. Okay, and we are adding the subsidies, because the subsidies are given by the government and it is gone to the factors of production. These subsidies are gone to the factors of production. Okay, and let's say that the factor cost includes the earnings of all the factors of production for their services, for their factor services that they are providing, and the market price is the price in the market. I hope you have understood that why we are adding the indirect taxes and we are deducting the production subsidies from the MP if we are going from the FC to the MP. Okay, so we have understood this logic. Now we can move forward to the other part, GDP MP and NNP FC. We have seen this FC and the MP, P is the same. So now we are left with the gross and the net. So this is the gross and this is the net. So how do we convert? What is the meaning of the gross and the net? See, in the gross, what is happening? We are adding the depreciation here. In the gross, the depreciation is added. Why? Why are we adding? What is the depreciation first of all? So depreciation is the wear and tear that is happening of the machinery. That is being the capital that is being used in the production process. So if the wear and tear is happening, that is we need to improve the machinery for further production. So that has to be paid. So the gross does not take into account the loss that is happening due to the depreciation that is happening due to the wear and tear of the machinery. So that is the gross does not take into account the loss that is happening due to depreciation, and the net takes into account the loss that is happening due to the depreciation. That is, you will be able to understand if we are taking GDP MP and we are taking the NDP MP. So everything else is the same. Just we have to convert from the net to gross. So NDP MP is 20 rupees and the depreciation that is happening, that is the wear and tear that is happening of the machinery, is 5. So we are saying that the total production is 25, while actually the total production is only 20. That is, this 5 is the depreciation that has happened, the loss, the wear and tear that the machinery has suffered. So we cannot add this 5, this depreciation in the while the GDP MP takes into account the depreciation. Okay, it does not take into account the loss that is happening due to the depreciation. It is just adding the depreciation. While in the NDP MP from GDP MP, we are deducting the depreciation, because the NDP MP is taking into account, because the net from the gross is taking into account the loss that has happened because of the depreciation. That is, from this 25 rupees we are deducting the 5 rupees that has happened due to the depreciation, and this is the 20 is the actual production that has happened. Okay, after we have improved the machinery again, after we have taken into account the loss that has happened because of the depreciation. So GDP MP does not take into account the loss that has happened because of the depreciation, while the NDP MP takes into account the loss. The net takes into account the loss that has happened due to the depreciation, and the gross does not take into account the loss that has happened due to the depreciation. Okay, it just adds depreciation into itself. So gross and net, I hope you have understood. The gross does not take into account the loss that has happened due to depreciation, and net takes into account the loss that is happening due to the depreciation by deducting the depreciation from the production. Okay, how much production has happened, and we deduct from that the depreciation, and it adds the depreciation, and that is, it is not taken into account that some loss has happened due to the wear and tear of the machinery. Now national versus the domestic. See, national, when we calculate NNP FC, there is this national and GDP MP. This is the domestic. So how can we convert from the national to the domestic? We have seen that how can we convert from MP to FC, from gross to net, from net to gross. Now see, when we are talking about the national, we are talking about the how much the residents of our country are producing. Okay, how much the citizens, or we can say the factors of production, that is the factors of our country are producing wherever they may be. Maybe some Indian is working in the America, so that is also the national product of our country, because our citizen is producing it. It must not have taken the citizenship of some other country, so that's why it is the normal resident of our country, that is the citizen of our country. So if citizen of our country is producing something or is earning for the services that it is providing. So that is said to be the earnings of the India that is added in the national income of our country. Domestic means that it should be in our territory. Okay, it should, the geographical territory of our country, of course, as well as the ships, the vessels, the airplanes that we have. Okay, because if the airplane is of India and it is going to some other country, Japan, it doesn't become the airplane of Japan if it is flying over Japan. Okay, so it is still the territory of our country. So the airplanes, the domestic territory means our geographical territory, plus the airplanes, the vessels, the ships that we have, as well as the embassies that we have in the other countries, like the Indian embassy in Russia. That is our domestic territory because our people are working there. Okay, it is the territory of India, we can say. So even if the residents or the non-residents are working, are earning in our territory, in the Indian territory, then also it will be said the production, the product of India. Okay, it will be added in the domestic. Domestic means whatever is being produced in our territory. Okay, even if the residents are producing it, even if the Americans, Japanese are producing it in our country, it will be called the domestic product because it is being produced in our country. While national product means that the residents of our country are producing it wherever it may be. So this means about the residents, that who is producing it. National means that who is producing it. When we say that our people are producing it, we add it. Domestic means that where is it being produced. When we say that in India it is being produced, that it is our domestic territory where it is produced, then it is added in the domestic product. Okay, so it means that who, and this means that where. Even if the residents are producing it, even if the non-residents are producing it, it does not care. And where is it produced, it does not, national income does not care, the national product does not care that where is it produced. So in the national, if we want to convert from the domestic, to the national, we need to add the net factor income from abroad. Okay, how much we are earning from abroad, how much our citizens, our factors are earning from abroad. So factor income, that is our factors are earning from abroad minus how much we are paying to the abroad. Factor income to abroad, that how much we have paid outside, we have to deduct that, and we have to add that how much we have earned from outside. That is what is national. Okay, in the domestic, if we are calculating the domestic from the national, we have to deduct net factor income from abroad. Okay, that we have to deduct that what we have earned from outside. We cannot add what we have earned from outside in the domestic because we are talking about the domestic territory. So in the national, we are adding whatever we have earned from outside, from abroad, because our people, our factors of production are earning it. In the domestic, we are deducting what we have earned from outside because we do not want to see that what is being produced outside. Even if our citizens are producing it, we only want to see that what is being produced in our country. In the domestic, we only want to see that what is being produced in our territory. And national means net factor income from abroad is added because we want to see that how much our citizens are producing, our factors of production, how much they are producing. That's why. So you will be able to understand this with an example. So GDP, MP, and NNP, FC is there. So from FC, if we want to go to MP, what do we need to do? We need to add indirect taxes. We need to subtract the subsidies, the production subsidies specially. Okay. From national, if we want to go to domestic, what do we need to do? We need to deduct the net factor income from abroad because we do not want to see that how much our citizens have produced outside. We only want to see that how much they have produced in our country, in the domestic territory. So net factor income from abroad had to be deducted. If we are going from the net to the gross, we add the depreciation because we are not taking into account the loss that has happened due to the depreciation. Okay, so if we are going now, I hope you have understood that how we are converting the FC to MP, how we are converting the national to domestic, how we are converting the net to the gross. Okay, now NNP FC. If we want to convert GDP MP into NNP FC, MP to FC, we subtract the indirect taxes because indirect taxes are not the earning of the factors. We add the subsidies, the production subsidies, because they are going to the factors of subsidies. The government subsidies are going to the factors of production. Then we add the net factor income from abroad because in the domestic, the factor income from abroad is not taken. what the citizens are earning. But in the national, we need to understand that how much we have produced, how much we have earned from outside, how much our citizens, how much our factors of production have earned from outside. So that is what net factor income from abroad we are adding, minus depreciation, that how much we have lost because of the wear and tear in the capital, wear and tear in the machinery. So from gross, if we want to go to the net, we need to deduct the depreciation, that is we need to take into account the loss that has happened because of the depreciation, because of the wear and tear. So this is the concept, that how we can convert from one concept to the other concept. With the same logic, you can convert from the GDP MP to the GNP MP. What do we have to change here? We just have to change the, like if you have GNP MP and you want to come to the GDP MP, what you need to do? MP is same, na? G is same, gross is same, so only the national and the domestic is different. So if you want to go to the domestic, you need to deduct the net factor income from abroad. As simple as that. Now I hope you have understood the concept, that how we can convert from one concept to the other concept very easily. Okay, this is for the factor cost, the market price. This is for the domestic national. This is for the gross and net. And where you have to deduct, where you have to add, I hope you have understood it now. So now I hope you can answer this question. This is the homework question now. And this also is the homework question. Okay, if you are not able to answer this question, do not worry. I will tell you that how this is solved in the next session also. Okay, so and do tell me in the comment section below, do you want me to bring the numericals for you, such kind of numericals, such kind of more questions, so that you get an in-depth knowledge. Okay, or you are like we have understood and we do not want any other session about this. If you have understood it in this session, because you know numericals can get a little tricky. Even if you understand that what is gross, what is net, it can become a little tricky. You need to do more practice. If you are doing it by yourself, that is very good. But if you want me to bring a session, another session in which we will just discuss all the numericals regarding the concepts, you can comment down below and I will surely bring next session on the numericals. Do answer these questions, and so that I also get to know that how much you have understood. Okay, so these both are the homework questions for you. And these are the people that have given the right answer of the previous session question. Utkarsh, well done, he even explained. And Arvind, Vanshika, Justin, Hansa, and Sanjay, Kiran, Katie, Mintu, Yash, Yashwant, Yash Patil, Marpu, Vinod Singh. So well done you guys, and you people have given the right answer. It was currency swaps, where the loan as well as the interest payments are swapped. Okay, and it should be in different currencies. So thank you very much. If you have any query, you can mail us here or you can contact us through this number. Thank you guys. Do comment down below that do you want a session, me to take a session on the numericals regarding the concepts. Okay, because today we have understood that what the concept is, and in next session we can do numericals if you want. So thank you very much. If you have any query, you can also comment down below. I will surely be seeing all the comments. So bye bye.